So we have to take a look at Senseonics Holdings, whose stock just outperformed the yearly return of the S&P 500 by about 6 times in the last 24 hours only, being up almost 42% today alone. This is all happening as a sort of recovery from pullbacks after initial spikes at the beginning of the year, from areas at around 40 cents up to more than $5.50. Before those astonishing gains today, we were sitting at the $2 mark, while the stock is currently trading at prices almost $1 higher. So what we are going to do today is give you an insight into what is happening to Senseonics stock and break down exactly whether it is still a buy at the end. And as the analysis in the video is absolutely crucial to consider before buying the stock, make sure to stay tuned. But before we jump right in, just hit that subscribe button down below. And as we'll keep you updated on breaking news and awesome trading opportunities every single day, subscribing would not only help us, but also you. So there is really no excuse for not smashing the subscribe button. It's free, and you can always unsubscribe if you feel so. Alright, let's start talking about the stock. So Senseonics is a medical technology company focused on providing implantable glucose monitoring systems or CGMs for those with diabetes. The company made some impressive progress on its commercialization of these devices and appears ready to target a multi-billion-dollar opportunity in the diabetes space. In particular, Senseonics Eversense XL product is what most investors have their eye on right now. But, and this is crucial to consider for our prediction at the end of this video, these devices haven't only received a lot of attention from investors. Ascensia, another huge player in the area for example, has backed Senseonics. In addition to raising capital via convertible debt with this Ascensia partnership, the two companies have embarked on a mission to bring Senseonics core products to market. This high-profile backer has provided significant validation to investors on the fence with the stock. Additionally, investors can start to see a path forward to long-term growth and eventual profitability if this collaboration yields fruit. And there are a few very important reasons to know before buying the stock that could prove this assumption. So as an early-stage medical device company, Senseonics doesn't have a lot of revenue to show for its efforts. Over the past 12 months the company's brought in less than $5 million in revenue. However, this stock has garnered sufficient excitement to justify a $850 million market capitalization. Accordingly, something must be up for investors to be willing to put their money to work in the company at these levels. That's what we have to take a look at now. So in early February, Senseonics announced the initiation of European commercialization activities for its CGM system. In partnership with Ascensia Diabetes Care, the company is looking to bring its 90-day and 180-day CGM products to market in Europe, with the hope that they will be well observed there. Ascensia has had tremendous success in marketing its Contour CGM products in Europe, and Senseonics is hopeful this partnership will yield fruit. As mentioned, the fact that the Eversense product is approved in the US and is beginning commercialization efforts in the US and Europe is important. These markets are two of the crown jewels in the global diabetes device market. According to recent estimates, this market could reach $4.3 billion by 2025. Sales are expected to grow at a significant rate of more than 16% a year. This would translate into an approximate doubling of revenue every 5 years if this growth rate persists over the long term. Indeed, if Senseonics can grab a large enough slice of this market, the company's near billion-dollar valuation could make sense. Not only that, it could be cheap, depending on how well Senseonics markets and commercializes its products. Nevertheless, this stock is certainly not cheap right now, and investors are taking a leap of faith of sorts with Senseonics at this level. Execution risk remains high with the stock, and the company will need to continue to show results from its commercialization efforts before we see this stock take off. So there is certainly huge potential growth here in the company, but it's nevertheless a risky pick considering the current valuation. Alright, with that being it for today's video, thank you very much for watching. If you liked this video and want to support our mission of providing free financial information to everyone here on YouTube, please ensure you're subscribed and definitely consider leaving a like. As mentioned before, it really means the world to us. Thanks a lot and see you next time.